facing stress. Companies are restructuring their loans as much as they can, and therefore banks are continuing to face that uncertainty in front of them. So from our point of view, we like public sector banks, but it's more of a timing thing. As we see more and more of this restructuring appear on the books, that's a time we'd like to probably own more of them. So we've been a little cautious ahead of all of these events. But as they unfold and the market starts getting potentially more worried about restructured assets, that's probably a better time to start looking at investing in these banks.
Right. The second fund is BlackRock Equity, which is a multi-cap portfolio. Now, my question to you is, how do you decide on what ratio do you need to keep between large caps, mid caps, and even small caps at times at different points as part of managing this fund?
We've kept it very simple. We've just bucketed it and told investors that we're going to have a roughly even split between large caps and mid caps. So it follows a broad 50-50 plus minus a bit exposure between large caps and mid caps. And that's a mandate that we'll run through at all points in time. We didn't want to get into the trap of trying to manage that exposure too actively, because the temptation is when mid caps are performing to go overly into mid caps and then not have the liquidity to get back into large caps. So 50-50 mix is really what it is, which we believe is a fairly reasonable mix to have. So in effect, the equity fund actually is a composite of the top 100 fund that makes up the large cap part of the portfolio, and our small and mid cap fund, which makes up the mid cap part of the portfolio. So it's sort of a reflection of those two products as well.
Autos, your focus has been with four-wheelers and auto ancillaries. I do not see two-wheelers as part of the portfolio. Why is that?
Well, again, in the four-wheelers, a little company specific, but as I mentioned earlier, we did take some calls early in the year on four-wheelers. At this point, clearly the environment for four-wheelers is looking fairly challenging, but our focus again is on companies which, in our mind have had a tough time earlier and are now repairing their balance sheets again. So unfortunately, I'm constrained to give names, so I can't specifically talk about that, but you can pretty figure it out. So that's again very specific on the four-wheeler side. Auto ancillaries generally again bottom up, but we like the broad themes primarily because of the fact that now that the rupee is also a lot weaker, their competitiveness on exports is high, so that looks reasonably good, and you've got some good quality companies in that sector earning fairly good return on capital. As far as two-wheelers are concerned, two-wheelers, we've been again, the companies that are available today are quite unique in their own ways. There's one two-wheeler company where half the business now comes from exports. There's another two-wheeler company which is sort of re-establishing itself, and then you have a new entrant also coming through. So our sense is that the space will get fairly competitive. There is again a time, we never write off views on a sector. It's always on our radar, and we look at it at a time that we think it's more appropriate. At this point, we just felt we're better off in the other two areas.
What about selecting stocks in the services space?
What we focus on is the return on equity of any business that you're investing in. So what are the profits that they're generating on the capital that they employ in the business? That's the return on equity. Now, whether you're in services or in infrastructure or whatever business, that's really the key parameter to determine how you'd like to value that business. The good thing in services businesses, they don't require much capital typically, and therefore the return on capital tends to be higher, the return on equity is higher, and therefore the valuations that they also tend to get is higher. Because as a shareholder, you own a part of a business that is generating very attractive returns, and that return has to influence therefore the value that you pay for that business. So across whether it's a services business or a manufacturing businesses, we're looking always at the return on equity minus interest rates in the system. That is the value that corporate is generating for any shareholder, the extra value over risk-free rates of return. And the bigger that gap, the higher is the multiple we're willing to pay for them. So we always look at this spread and the P multiple or the price to book, and basis that we value it as a services company or an infrastructure company.
Alright, the next fund is BlackRock Microcap, which is a small cap fund. In the risk profile, I see that with the beta being sub 1, you've been able to generate an alpha of 15.3 plus. How have you managed to do that, especially given the profile for small caps?
That is pure bottom-up stock selection. When you go down the micro-cap range, and for us the definition of micro-cap is a company outside the top 300 by market cap. So, beyond 300th by rank of market cap starts qualifying as micro-cap for us. As you go further down the chain, as you'd be more than aware, I think due diligence, the sort of work you have to do in a company actually increases. You have to be a lot more comfortable with the management, with their ability to deliver the business characteristics that you're buying. So what we've tried to do in the microcap fund is just have it very simple. We focus on businesses that we think are scalable, backed by managements we think that can deliver the scalability. And as long as we think that the valuation is broadly in the range we'd like to own it at, it's fine. Those are the very three simple criteria we'd follow. I'd say in the pecking order, scalability is the biggest criteria. We don't even mind paying a higher price for scalability because, as companies scale, their valuations improve. And of course, management also is very critical. So you've noticed right through that portfolio, we've tried to ensure that we have, fairly high quality managements because that's the place you can stumble and, create some big lemons as well. So I think the focus in the microcap fund has been bottom-up stock selection. I think the thing that at least gives us greatest comfort is the fact that the performance has been achieved with a fairly good quality portfolio. We haven't had to take extreme risks to deliver that performance, but it's been purely bottom-up. I think to some extent the fact that the last 3 or 4 years have been fairly defensive or have not been crazy in terms of market behavior where you have all and sundry moving up has also helped this fund because it is managed in a fairly conservative fashion. So that's really been the contribution.
Right, the next fund is BlackRock Small Cap and Mid Cap. Some of the names that I see as part of the portfolio are Godrej Industries. There's focus on financials, so Group Finance, Bajaj Finserv, some auto ancillary names. You have Apollo Tires, Eicher Motors also as part of the portfolio. How would you distinguish this portfolio versus a BlackRock microcap?
Well, one is the range of stocks that you can invest into. So the way we define large caps, mid caps, small caps, and it's worth defining here because there's always some confusion on what is a large cap, what is a mid cap, what is a micro cap. So the way we see it is the top 100 companies are called what we call large cap. The top 100 companies by market cap, if you just ranked the entire universe. And today the 100th company in India has a market cap of a little over $2 billion. So 2 billion and above, there are 100 companies and they're all large cap by our definition. The next 100 companies, which is 101 to 200 by rank, is what we call the mid cap space. Now, interestingly, the 200th company in India is roughly half the size of the 100th company by market cap. So it's about $1 billion. So $1 billion to $2 billion of market cap, you've got another 100 companies, which we call mid caps. The 201st to 300 is what we call the small cap range. And again, this is the funny part about our markets. The 300th company is about half the size of the 200th company. So it just keeps halving. So the 300th company today is about $500 million. So you've got another 100 companies. And anything below that, finally, we just put in one big club as micro cap. So the small and mid cap operates in the 100 to 300 range of market cap by rank. And the micro cap focuses on beyond 300. So that's the distinction, which is why the portfolios are not the same.
So has this strategy of stock selection across different funds helped DSP BlackRock to outperform the market and its peers? Dhirendra Kumar of Value Research joins us for that and more.
Concerned about the safety of your house, but through a simple sojo. With National Insurance's Householders Insurance. Prompt service, hassle-free process, fair settlements. Simple.
Real victory is about winning hearts. That's the mark of a champion.
Thank you.
Welcome. Indian Overseas Bank. Touching hearts. Spreading smiles.
Welcome back. You're watching Meet Your Fund Manager right here on ET now, and we're discussing the equity schemes of DSP BlackRock. Joining me on the show right now is Dhirendra Kumar of Value Research to discuss those schemes. Dhirendra, thanks very much for taking out the time. Let's start by discussing BlackRock Top 100. It's a large cap fund. What's your view here?
It's an outstanding fund, and over the past 5 years, what we have seen through all these turbulent times is it turns out to be the best performing large cap fund. And it has done it with, great discipline, with its diversification, keeping it focused, style purity, being into large caps always, and following its mandate, never slipping below the top 100 capitalized companies. And selectivity also has worked for this fund, and a good large cap fund.
The next fund is BlackRock Equity, which is a multi-cap fund. What is your view on this fund, Dhirendra? And also, what is your advice to investors who would want to take exposure to such portfolios?
I would say that in the near term, it has not done very well. But I would say that if we take into account that its long tenure, it's among the oldest, it is the oldest equity fund from DSP. And those numbers look compelling. I would slot this fund as a above average, not the best in its class, not the best among the multi-cap fund, but is still an above average performer. And taking into account its very long tenure, I would say that outstanding long-term performance and superior options visible in near term.
The next fund is BlackRock Microcap, which is a small cap fund, high risk, high return strategy. What's your view here?
DSP BlackRock Microcap is a fund which is not suited for every kind of investor. But Microcap is an outstanding fund, and it did show its mettle. It is not supposed to invest in the top 300 capitalized companies in the country. So slipping below that, it is a microcap fund. It has remained true to its label. It is about 75% into microcap. I would say that small cap stocks only. And even through difficult times, a difficult phase in the market, and in its life so far, large period has been difficult period. Even in that period, it has retained its focus, and I would say it's an excellent fund, not for every investor.
Also, Dhirendra, what's your take on a fund like BlackRock Small Cap and Mid Cap, which is another fund from DSP BlackRock stable, which addresses the broader universe of stocks?
This is a relatively, superior performer in the mid cap segment, and we have a large universe of funds to choose from. And this fund has built a good case for itself. Of course, in its history so far, a good part has been where it has struggled. But looking at its 17% annualized return since its launch, I think that's outstanding. And this is not for here. I think the fund manager shows selectivity, the kind of stocks which is generally not visible in other mid-cap portfolio, though most mid-cap portfolios are quite different. And so is this, and this has, the fund manager has impressed investors with his stock selection here.
Well, Dhirendra, thanks very much for joining us and giving us your perspective on these funds. With that, we come to the end of this edition of Meet Your Fund Manager. Do send us your feedback and suggestions. We'll appreciate it.
नेहा, क्या हुआ? कुछ नहीं. I quit.
ये क्या किया तुमने? इतनी अच्छी कंपनी, इतना अच्छा जॉब. अब तुम्हारे लोन्स का क्या होगा? EMIs का क्या होगा?
नेहा, बुरा मत मानो. Your husband's just worried about you. Husband? He's not my husband. He's my stockbroker.
We don't just help you invest your money. At Nirmal Bank, it's a relationship beyond broking.
Interview. Good luck.
I have my good luck.
Guys, thanks. We found our man. Better luck next time.
Monster.com. Better access, better connections, better jobs. Log on to Monster.com. Find better.
Livelihoods rely on businesses. Like businesses rely on financing. So in times of uncertainty, we help to keep trade flowing. and keep industries running. Because of this, life can continue as usual. Standard Chartered, here for good.